time value of money. The time value of money is an interesting concept that everyone seems to understand, but is hardly ever defined. Regrettably, the definition is not found in a typical dictionary. So after a short web search, the following definitions surfaced. First, I looked at Wikipedia, which is not always a dependable source of information, but it has a good definition. It says, quote, "The time value of money is based on the premise that an investor prefers to receive a payment of a fixed amount of money today rather than an equal amount in the future, all else being equal." End of quote. Investopedia, which sounds good on the surface, tended in many more words to affirm that prior definition. GetObjects.com also described it saying, quote, "Time value of money is based on the concept that a dollar that you have today is worth more than the promise or expectation that you will receive a dollar in the future." End of quote. The summary of the above is that a certain amount of cash is worth more today than it will be in the future. So how does that affect us as we go about our daily lives? First, it means that when we borrow money today to be repaid at a later date, we pay more money at that later date. The difference is what we call interest paid. And second, it means that when we loan money to somebody else today to be repaid at a later date, we expect more money at that later date. The difference is what we call interest earned. There are a number of formulae that reflect that relationship between money now and money in the future. We're going to go into some of them at a surface level so that you'll understand them when you encounter them in the future. The first is the concept of interest. Interest is the compensation that a lender earns for delaying their own use of money and letting someone else use it. It is made up of three components. First, an agreed-upon value for that postponement of the lender's spending. Second, a premium for the possibility of inflation. And third, a premium for the risk of the loan. The first two components together make up what is called in the United States the nominal risk-free rate. In other words, that is what would be earned from a totally dependable borrower. It usually equates to the rate of the United States government treasury bills. The third component relates to the perceived creditability of the borrower. For example, most people accept a very small interest rate for putting their money into savings accounts at the banks. Banks are perceived to be risk-free since they are usually insured against loss by the United States government. That is about the lowest commercial interest rate that you can earn, and it's because there is no perceived risk. On the other hand, if someone was to consider loaning money to a recent college graduate with a degree in Renaissance art history and no job, the risk factor would be significantly higher. Without spending a lot of time on the comparative value of college degrees, I think we can agree that this person is going to be charged a lot more interest than you would get loaning money to a bank. How this works. Assume 6-month T-bills are running at 4%, and you wanted to borrow money from a bank for 6 months. The difference between the 4% and what the bank is going to charge you is the risk premium. Simple interest is usually quoted as an annual rate. If the rate is 6% and money is being borrowed for 6 months, the calculation comes to 3%. If money is being borrowed for 2 years, the simple interest will be calculated as 12%. To complicate matters, interest is almost always compounded. Compounding was described by Albert Einstein as the 8th wonder of the world. Compounding allows the lender to charge increasing amounts of interest as the time the money is loaned increases. Here's a comparison of simple interest versus compound interest. A person loans $1,000 to another person at 12% simple interest for 1 year. The calculation is $1,000 times 12% or $120 interest. Simple, eh? The same scenario, only with the interest compounded monthly for the year, goes this way. The calculation for the first month is $1,000 times 12% divided by 12 months, or $10 interest for the first month. The second month, the interest is charged on both the original loan plus the interest earned, or $1,010. Apply the same formula and the interest for the second month is $10.10. The third month, the same thing happens to the new balance of $1,020.10 and the interest is $10.20. This goes on for 12 months until the total amount, interest plus principal, of $1,126.83 is to be paid to the lender. Now $6.83 doesn't sound like much money. If you think of the huge amounts of money being borrowed and lent in this world, the difference comes out to a significant chunk of change. Even the $6.83 should get you a meal at a cheap takeout. The real lesson here is that you want to be an investor, not a borrower. That should put you on the benefit side of compounding rather than on the paying side. Nomenclature for this concept includes the following. Interest, a small I, is already described. Principal, a small p, is the amount loaned or borrowed. The period, a small n, is the function of time, usually in days, months, or years. The present value, capital P, capital V, is today's cash. The future value, capital F, capital V, is a present value with interest factored in. An annuity is a series of payments. The formula to calculate these are listed here. Be sure that you are using apples with apples and not apples with oranges. To explain what's being said, if you are using months for the N component, the I component also needs to be expressed in months. The formula for simple interest as shown on the screen is P times I times N. $1,000 for P, 12% for I, and N is 1 year. It's a very simple formula. Interest equals $1,000 times 12% times 1, which equals $120. The formula for future value, which is compounding interest, is FV equals PV, open paren 1 plus I, close paren, to the nth power. So if PV is $1,000 and I is 12% per year, or remember apples to apples, 1% per month, and N is 12 months, the future value, or FV, equals $1,000 times 1 plus 1% to the 12th power, which is $1,126.83. The formula for present value is PV equals FV, open bracket, 1 divided by open paren 1 plus I, close paren, to the nth power, close bracket, with the future value equaling $1,126.83. I, again, is 12% per year, or 1% per month. N is 12 months. So the formula is PV equals $1,000 times open bracket, 1 divided by open paren, 1 plus 1%, close paren, to the 12th power, close bracket, which equals $1,000. Now finally, an annuity is a series of payments. In order to not get too complicated, we're not going to get into annuity formulas here. If you wish to pursue those, do a web search or get a book on finance from your local bookstore. The topic gets very complicated and cannot be done with justice in the time allotted for this presentation.